welcome to Know Your Company. I am Mahima Vachrajani. This is a show where we take up one company every day and dissect the company in and out. And the company that we've picked today is IndiaMART interMESH. It's a very interesting company. Why we have chosen this company? Well, first of all, it came out with its Q1 FY26 earnings over the weekend. A couple of things that I would want to know about this company, that is, when is the recovery expected in the silver category, because the churn has remained elevated in this particular category. In terms of the top 10 customers of this company, there is strong realization that has happened this quarter and has been happening since the past few odd quarters. Will this continue is something that we would want to know, and we would go ahead and ask the management about this as well. In terms of the margins have continued to improve not only quarter on quarter basis but also on year basis. But we want to know as to how sustainable this margins growth is, because the company is spending in terms of their ad spends. They're going ahead and spending more and more on their ad spends, and that is bringing them unique business inquiries as well. So we want to know as to how sustainable margins will be going forward. Now, ad spends have driven up unique business inquiries, as I mentioned earlier also. We want to get a sense as to how ad spends will increase going ahead. What is the kind of trajectory looking like, and what will be the margin impact going forward because of that? The next thing that I want to know is that overall buyer traffic trends, what are they looking like? Because it's an interesting business where they are facilitating businesses overall. What are the buyer trends looking like right now, and what is the growth outlook looking like? The last one that I want to know is the kind of revenue contribution that is coming in from premier customers, because this is something that will augur not only their top line but also their margins going forward, and what percentage of their total revenue is coming from those premium customers, and what are they doing actually to retain their premium customers. So these are the few pointers that we would want to know about this particular company. Now on to what the company actually does. IndiaMART interMESH, what is the company's operations looking like? First of all, it's India's largest online B2B marketplace. It's a two-way discovery marketplace. So a buyer can find a seller and a seller can find a buyer as well. It also has diversified effects across categories and geographies. I'll come to how the network is exactly for this company in the further slides. In terms of the algorithm that the company uses, that is behavioral driven. So overall, how the buyer reacts to any particular product or services is something that will drive the seller, and vice versa. The services that empower business is something that this company actually does. In terms of the overall network, it's a well-diversified business. Around 98,000 plus categories is something that the company already offers. Operational in 56 odd industries, as well as around 119 million products is something that they already carry. In terms of their overall geographies, in terms of buyers, if we take a look, metro cities is around 29%. There is tier 2 cities, which is around 24% buyers are coming from, and there is 47% buyers coming in from rest of the India. Now talking about the sellers, we've seen that metro city has the highest contribution there, around 53%. 27% comes from tier 2 cities in terms of where the sellers stand, and rest of the India, around 19% of the sellers come from there. In terms of their overall revenue model, it's basically a subscription based model with overall a negative working capital for the counter. In terms of the revenue breakup, in terms of the customer wise data, the top 1% customer is around 17% of their total revenue. In terms of and of course that includes 2,000 of their overall suppliers. Overall top 10%, that includes 22,000 suppliers, but that's 50% of their overall revenue. So this is a big chunk out there, and total they've got around 218,000 suppliers, which is almost of course the overall 100% of their revenues. Now in terms of the key competitive strengths, we talked about the network, but in terms of the key competitive strengths, they've got around 29 million unique business inquiries. There's 152 million overall replies and callbacks that the company generally gets. 43 million active buyers right now on their platform. Overall 58% repeat buyers, which is pretty high. I mean, as compared to something like a Just Dial, of 58% of percentage of repeat buyers is quite a good number. In terms of overall suppliers, that comes out to around 8.4 million. Paying suppliers, that's the 218,000, that's the paying suppliers that they have on their base right now. And lastly, in terms of their overall listed products, that includes 121 million listed products and 98,000 odd categories that I mentioned earlier as well. So that's with regards to where the entire about the company for IndiaMART interMESH stands. Now, to give viewers a perspective that how we will evaluate each of these parameters for these companies. We'll take a parameters of income statement first, followed by balance sheet, cash flow, as well as return ratio, and see how they fared in the past few odd years. Then we'll talk about how shareholding pattern is looking like for the counter. We'll also take a look at how the stock has performed over the past 5 odd years. We'll also take a look at valuations right now compared to its forward-looking valuations as compared to its peers as well, and lastly in terms of what brokerages are penciling in when it comes to this counter. So without further ado, let's take a quick look on firstly the income statement as to how that is faring. Overall, in terms of the income statement, the revenue has seen overall a 3-year CAGR of 23%. So that's not a bad picture, especially in this particular business. In terms of FY22 revenues, they stood at around 7,500 odd crores, which has gone to almost 1,400 odd crores in FY25. So nearly doubled there. In terms of the EBITDA, the 3-year CAGR has been around 19%. So good growth there as well, from a 300 odd crore in FY22 to almost 523 crore in FY25. In terms of the margins, there has been a slight dip as compared to where FY22 stood. FY22 the margins were at 41%, then they came to around 27 odd percent, and right now in FY25 they stand at around 38%. So sharp recovery in the past 3 years, but the question really here is whether it will be able to come back to those margin levels of 41%, considering that the company is spending heavily in terms of advertisements. So that's one question that we need to ask the management too. In terms of the net profit, the overall 3-year CAGR has been similar to that of the revenue CAGR. It's been at 23 odd percent, from a 300 odd crores in FY22 to almost a 551 crore in FY25. So nearly doubled here as well in terms of net profit. Now in terms of how Q1 fared for the counter, the stock is under pressure today, but overall good set of numbers. In Q1, revenue was up almost 12%. EBITDA up 11%, net profit has seen a significant growth of around 34 odd percent. Margins have taken a slight hit, but overall that's because of ad spends going up. In terms of operational metrics as well, collection from customers has grown at a CAGR of whooping 17%. License sold has also grown at a CAGR of 9 odd percent, and net billing has also seen a CAGR growth of around 23 odd percent. So overall, in terms of where income statement stands, it's a thumbs up, because both the top line as well as bottom line has grown over 23 odd percent in the past 3 odd years. That's a 3-year CAGR. Moving on to the next aspect, that's balance sheet. It's an interesting one. The company's equity has seen a slight raise in the past 3 odd years. Overall, the reserves have also continued to grow for the counter, and they've maintained those reserves. And overall, if you see the cash in bank also, there's no borrowing for the company, and that's an important one, because the company does not have any borrowing, and the cash position also remains pretty stable, from a 58 crore in FY23 to around 84 odd crore in FY25. Overall, all of these metrics indicate that a healthy balance sheet is there, and that's why we've given a thumbs up to where it comes to the balance sheet aspect as well. The next one then is cash flow statement, an interesting one here as well. Cash flow from operation has seen a steady growth when it comes to their overall operations, from a 476 crore in FY23 to around a 623 crore in FY25, a steady growth in terms of where cash flow from operations is concerned. And this is despite of the kind of overall churn going on in the silver categories, plus the kind of headwinds that the entire industry has already seen. In terms of their cash flow from operations to PAT, that ratio has slightly come down, but it still stands at around 119% in FY25. So that's a strong percentage in terms of ratio to take a look at. Although it was at 178% at a given point of time in FY23, so that's an important aspect to keep in mind too. Lastly, in terms of net cash flow, negative in FY25, but overall, since the cash flow from operations to PAT is healthy, we've given this particular aspect a thumbs up where it comes to the cash flow statement. The next aspect is the return ratios. Return ratios have been topsy-turvy for this particular counter. If you take a look at the return on capital employed, at one given point of time it was 22% in FY21, then it went down to almost 9% in FY23. but it's bounced back in FY25 to that 19% mark. So the question here really is that whether they'll be able to maintain or even grow their return on capital employed going forward or not. The return on equity again at elevated levels in FY21 stood at around 30 odd percent, came to the 14% mark in FY23 and now has grown to 28% and almost nearing that 30% mark in FY25. So the question really here is also that whether the company will be able to maintain that 28% in terms of ROE or maybe even grow further from that 28% mark and come back to the 30% mark where it was in FY21. The next one is shareholding pattern. Of course, for the return ratios, we've given it a neutral rating right now because we did see a dip as compared to where it was in FY21 coming back to FY23. So we'll have to wait and watch here as to how beyond that FY25 these return ratios performed, and that's the only reason as to why we've given a neutral rating to this particular counter. The next one is shareholding pattern. The shareholding in terms of the promoter, it's a well-held company. Promoters have continued to hold that 49% level in the counter. In terms of the FI holding, that has slightly come down, not slightly come down. In fact, it's come down from the 26% mark to almost 18% mark. So FIs have been slowly selling in the counter. In terms of the DIs, the overall holding has gone up from a 5% mark in March 23 to almost a 15.5% mark in March 25. So DIs have been increasing their stake in IndiaMART interMESH. Public holding has slightly come down from that 18% mark in 2023 to around 16% mark in 2025. The interesting aspect here is that number of shareholders have slightly come down for IndiaMART interMESH from around 1,77,000 odd shareholders to around 1,68,000 shareholders is the count that we have as of March 25. So because FIs have been selling their stake in the counter and shareholders, number of shareholders have taken a slight dip, we've given a neutral rating to this aspect as well. The next one then is street cred. Interesting one. 1 month the stock has seen a growth of around 6 odd percent. 6 months it's seen a growth of around 16 odd percent. Year to date again 16 odd percent. 1 year the stock has not done anything. I mean it's down around 0.7 odd percent, and 5-year performance also of the stock has been muted. I mean it's given returns of only 117%, which is why this particular aspect we're giving it a thumbs down, because 5 years the share has disappointed their shareholders overall. Then it comes to valuations. Now the only peer right now in the listed space for IndiaMART is a Just Dial. As compared to Just Dial, IndiaMART is slightly expensive. The overall FY26 estimates as per Bloomberg suggest that the PE stands at around 30 times. That will go to around 28 times in FY27. This is again as per Bloomberg estimates. This as compared to Just Dial, which stands at around 13 times in terms of FY26 estimates, and will remain at that 13 times in 27 estimates as well. So because it is slightly expensive than where its peer stands, that is Just Dial, we've given it a neutral rating as of now for valuations picture. Lastly, in terms of analyst recommendations, where in terms of where the analyst recommendations stand, there are around 8 odd buys, 5 hold, and 8 sell for this particular counter, and a return potential of around -1% as per what Bloomberg suggests. So that's with regards to where the analyst recommendations stand, and we've given this aspect also a thumbs down. So that brings us to the overall rating, and let's take a look at the overall rating as to where the company stands. Overall income statement, thumbs up. Balance sheet, thumbs up. Cash flow is a neutral. Return ratio is a thumbs sorry, the cash flow is in fact a thumbs up, and return ratios is neutral. Shareholding is neutral. Street cred is thumbs down. Valuations again a neutral because as compared to peers it's slightly expensive, and street coverage thumbs down because there are 8 buys and 8 sells as well, and a negative return potential of around 1 odd percent. And that brings us to the overall rating of 4.5 out of 8 for IndiaMART interMESH. Now with that, let's also welcome in our guest for the day. We have Dinesh Agarwal, CEO and founder of IndiaMART interMESH, joining us now. Mr. Agarwal, always a pleasure speaking with you. You know, before I move on to the details of the company, your sense of how the quarter has gone by. You know, it's been a good quarter. I was just going through your investor presentation. You know, operational metrics have improved. Overall numbers have improved. Net profit has seen a good growth. What is your sense? Did it meet your internal expectations? What's the view like?
Yes, I think given that last couple of quarters have been muted, I think we are happy to say that we are back to a 10% growth in the standalone collections, while the revenue from operations from the previous collection is showing muted growth. I think we are happy with the overall performance. We would have been happier if our churn would have come down and we could have added more number of paying subscribers. But otherwise, all in all, I think we are happier with the team performance and happier with the product performance.
Okay, Mr. Agarwal, you've always been candid about how churn is very high in the silver category. And I really appreciate that. But I just want to get a sense because, in the past few odd quarters, we've been constantly observing that the churn rate has remained high in the silver category. When do you expect a recovery? And then how do you, expect that impact to be on your financials?
See, two things will. First thing is that once the churn starts to improve, the only thing that we can do is improve the product and product market fit. You never know when do you get 100% right. So we continue to make changes cautiously to the products, as well as we are working towards training and education of our team as well as our newer customers. Now, once the churn comes to the little lower levels, if not pre-COVID levels, then I think we will start to spend money on the sales side of it, and that sales side of it money could have a impact on the EBITDA margin in the near term, but in the longer term, I think the overall growth in the business will continue to happen. Even today, we have about 50% of our customers, which are gold and platinum, contribute about 75% of our revenue and most of our profit. So I think our reliance on silver is lower in terms of the financial performance, but in terms of the growth outlook, I think we continue to work towards improving the product and servicing levels to see how we can improve the paid subscriber addition. From there, we can continue to nurture those customers into gold and platinum customers.
And is there a timeline in place or a possible target in place that you have in terms of converting those silver customers into gold and platinum?
I think silver customers converting into gold and platinum at a healthy pace. The basic issue is that the silver customers themselves are not staying enough. Our retention level for the first 1 year, that is the first target. I think how do we improve our retention level at the 1 year of the silver customers?
Okay, interesting. Mr. Agarwal, your margins have continued to improve, in the past few odd years. Just want to get a sense because in terms of overall improvement, yes, year on year they've improved, but there was a given point of time when, you did have EBITDA margins of almost 41 odd percent. But if I'm not wrong, your guided range right now is anywhere between the 30 to 35% mark. Just give us a sense as to, what will be the proper range of margins that you're looking at, because 30 to 35% is a big range. Will it be at the higher end of that range? And is there a further scope of improvement there? And if yes, what will be the levers?
I think I have always guided to stick to around 33% of the margin for the longer term. Now, on a quarter-on-quarter basis, there might be changes, as well as on the year-on-year basis also there might be changes. But on a longer term, I would like to maintain an EBITDA margin of about 33%. That is what I have been guiding. Now, currently, because we are not making enough investments in the sales side because the churns are elevated, and that is why the EBITDA margin looks at 38-39%. So once we start to at a steady state level, I think the if you look at the 3-5 year CAGR level, I think 33% is the right EBITDA to look at.
And in terms of your ad spends, because even they are going up, and that is what is actually bringing you your unique business inquiries, correct? And you've guided for a 6 to 10 crore amount that you'll be putting aside every quarter for your advertisement spends, and that from your reading, I understand, will also increase going forward. Then what is the kind of impact that you're seeing on the margins, and what's the kind of overall growth trajectory that you're seeing in terms of your advertisement spends?
No, so currently I think 6 to 10 crores is a good number, and that amounts for about 2 to 3% of our revenue. That is taking into account we are still guiding at a 33%. I think whenever if we are going to increase the advertising spend, we'll come back and let you know. Currently, for the next 2 quarters or so, I think 6 to 10 crore rupees per quarter is a good number.
And Mr. Agarwal, what are the buyer traffic trends looking like right now?
Good. Actually, if you really see after the COVID, 1 year of the buyer traffic was almost stagnant because the in the COVID suddenly the buyer traffic had grown by almost 33%, and then when the markets opened up, market went to the offline markets as usual. However, from there on, we have started to see upwards of 10% growth in the buyer unique business inquiries. If you see in the last quarter itself, we have grown by 16-17% in the unique business inquiries. Out of that, about 10 odd percent is organic, and 6-7% came from the amount that we spent, about 6 crore rupees that we spent. So, all in all, from that side, I think we are happy. We need to increase the repeat user base quickly, and frequency of those repeat users quickly. If you see in the last quarter, it was the highest ever repeat user at 58%. We are confident that the product market fit, that changes that we are doing, they are working slowly and slowly, albeit slowly, but I think in the right direction.
Interesting. And do you have a internal benchmark in mind that you have right now for unique business inquiries as well as your collections and supply storefronts?
Yes, so I think unique business inquiry, if we continue to grow at 15%, that would be a very healthy number. On the collection and subscriber addition, as I said, since our churns are elevated, we are not able to guide anything in particular. In the past, if you see, our paying subscriber additions have also been growing at 10 odd percent, and ARPU has also been growing at 6 to 8%, and that is what our collection was growing. Now, given the last couple of quarters, since there is a churn is elevated, most of the heavy lifting is being done by the ARPU, and ARPUs are growing consistently healthy. Even this particular quarter, 9% ARPU growth has come in. So I think we are happier on the ARPU growth, and that proves that for the gold and platinum customers, the product market fit is working very well on them. While on the silver side of the customers, we are still finding problems in retaining them for a larger number, and that we are working towards, and we'll be able to solve in coming times also.
Today, in terms of the revenue contribution from premium customer, that is also on the rise, which is a positive for the company because that will also aid your bottom line and margins. What's the outlook there?
Yeah, we have consistently grown in the last 5 years. If you see, we were at 40% for the top 10% customer when our customer base was 1,50,000. Now our customer base is 2,20,000, and our top 10% customers are now paying about 50% of the revenue. As I said, gold and platinum account for almost 75% of our revenue contribution, and that is healthier for the company, and we will continue to inch up slowly and slowly on that.
Mr. Agarwal, one last question to you before I let you go. You know, March 25 ended with almost 1,400 crores in terms of your top line and 550 crores in terms of your bottom line. What's the target that you have in mind when it comes to FY26 for your top line and bottom line?
I think we will try for a double-digit growth, and let's see what happens.
And what would that range be in terms of double digit?
I'm unable to give you any guidance. As I said, given the elevated churn, let us look at the double-digit growth if we can target.
All right, Mr. Agarwal, I tried my best to get that answer from you, but thank you so much for taking out the time and speaking to us at NDTV Profit, and all the best for the future.
Thank you, Mahima. Thank you.
All right, so that was the management of IndiaMART, interMESH. Interesting, conversation there. Margin guidance at that 33%. Management also plans to spend 6 to 10 odd crores, in terms of advertisement. Every quarter, premium segments will be the key lever, as well as management confident of the ARPU growth going forward as well. But with that, we're completely out of time on this edition of Know Your Company. Stay tuned to NDTV Profit for more news and updates on the other side.